Good evening and welcome to the weekend edition. My name is Peter Resnick from ShadowTrader.net. Good to be back with you, especially after last week's hiatus. Tariffs, employment, Russia. I don't even know if those things go together in the same sentence, but that's what was happening towards the end of this week between like late Thursday and all day Friday, causing a lot of volatility. I'm going to break that down for you in detail in an expanded weekend review section. You know, we always kick this show off with the weekend review, talking about the percentage change from open to close Monday to Friday of the 11 sectors, etc. I want to expand on that a little bit because I'm gearing up for the new studio, which I've got some good news on that front. Hopefully September is when you're going to be seeing me in the new studio. Let's call that Weekend Edition 2.0. As such, I'm always looking to expand on this program, maybe bring in some new segments. And one of the things I've been thinking about is expanding that weekend review a little bit so we can get an idea of what the news flow was on each specific day that may have caused, you know, some of the moves that we're seeing. So we'll just kind of kick it off with like a light version of that. And if it catches some traction, maybe we'll start including that later when we're in the new studio. All right, beyond that, I have a Fed watch for you. Very, very important. We got a lot of news on the Fed front, especially given the fact that we had a meeting this week, but also other things going on with the Fed this week. Market profile for sure. And I'm going to leave you with some trade ideas. There's a lot of good stuff that's pulling back right now and now finally coming into some buy points. And I want to talk about some of those stocks for you and see if those are going to be tradable. All right. All that and much more in today's Weekend Edition. Kicking it off as we always do with a little look back, weekend review. Remember, these are 11 sectors of the S&P and key financial instruments, seeing how they acted from the Monday open to the Friday close. I always like to put that caveat out there. No gaps over the weekend count, so it's everything that open to close because we're only interested in what is actually tradable, right? And you can see everything was pretty much down across the board. The only place to hide really was in utilities, and we'll talk about that a little later on as to why that was. I think everybody knows probably why that was, but notice S&P down 2.5, NASDAQ down 2.5, Russell took the brunt of the selling down 4, and sector-wise, we were pretty much down across the board from technology all the way to communications here, and from staples all the way to real estate here. And I guess, and again, as I was saying, only those utilities fared a little bit better than everything else. You can see here discretionary really got hit pretty hard because you had Amazon on a gap down, so obviously market did not like that, or rather the discretionary got hit a little bit on Amazon. Tesla was also down a good clip this week, but really just across the board. I mean, materials down 5, you know, healthcare down about 4, financials down 4. As we know, this is the heaviest weight in the market right here. This is just a huge percentage of the market. You're talking about 47.8 now, because we just got new weights. I keep looking over here because that's where I have the sector weightings on my boxes. Almost 48% of the market. It's 47.8 right now. So almost half the market literally is tech and financials, or half of the S&P, I should say. So this is really what matters the most, and this contributes the most to this downward action. So just kind of keep that in mind. Bonds up a bit, rates dropped a bit, because you can see here 10-year yield dropped about 4%, so bonds rallied off that. The VIX was up about 35. I don't put a lot of stock into that. I didn't think it was that big of a move in volatility. When the VIX gets, you know, really low, it doesn't take much to have a 35% move. Gold had a decent end of the week. It really was not doing so hot, and then on Friday we perked up a bit. Oil was up about 3%, and Bitcoin really got smacked. A key technical area in Bitcoin, I should say, at the prior high breakout point was violated, almost I should say, not in the continuous contract, but in the current contract. And if you're watching my pre-market perspective video this morning, which I put out for free on Twitter, I actually had a nice Bitcoin buy overnight on Thursday night while I was sleeping at like 4 in the morning. I purposely had a limit order right at that prior high breakout point or just above it. That got filled. I woke up to a large gain, which I showed you in the video, but I had to put that stop break even, and then within a couple hours, Bitcoin just fell apart. I think it started trading more like a risk asset today, to be honest with you, with the market coming down. We talked about this in the past, how there was a decoupling recently where we had that run in Bitcoin moving up without the market, but I feel like today, Bitcoin succumbed to the pressure of trading kind of lockstep with the market again. That's why it kind of fell apart. I could be wrong on that, but that's how the price action really fell today, that we went sort of back to that old paradigm of Bitcoin trading with the market. And anyway, at the end of the week, we were down 5%, a little bit more than 5%. All right, so that's the weekend review as far as the sectors are concerned and everything. But what I wanted to talk about in addition is this action here, which is a bit more fundamental. This is what I alluded to in the introduction. And of course, I don't have this fleshed out yet. When we eventually get to this, talking about some of this news stuff on a day-to-day basis, I will of course have better looking graphics. I'll figure something out for the new show. But for now, this is just cut and paste that I got off briefing.com, which is where I get all my news. And a lot of this here deals with basically late Thursday after the close into Friday. And this was the volatility that really kind of killed the market overnight, caused the futures to be gapping down really sharply on Friday morning, because the August 1st was the deadline. So you had the tariffs basically kicking in, and Thursday was the 31st of July. And so obviously at midnight on Friday, it was August 1st. And stuff kicked in. And in addition to that, there were elevated tariff rates for key trading partners put up. And it was, here it is, a new round of reciprocal tariffs set to take effect on August 7th. That was an executive order yesterday that adjusted it. But that included increases to 50% for Brazil, 35% for Canada, up from only 25%, 25% India, 20% Taiwan, 40% tariff on all transshipped goods regardless of origin, making a significant escalation in trade policy. So obviously market did not like that. And on top of that, remember that Thursday night was Apple and Amazon, and neither of these stocks fared well on Friday. They were both down sharply. So that was the situation, at least with tariffs, right? Then we get to employment, as I was saying, and that was really weak. That was 8:30 a.m. on Friday morning, and that just exacerbated the situation more, because if you recall, the payrolls came in short. Like they came in at like 73,000, very low, but not only very low, they revised down the prior two readings, okay? President didn't like that. I heard he fired the person that was in charge of that, kind of without cause. No real proof that there was any data manipulation, but saying that the data was manipulated, and so that person lost their job. But regardless, market did not like it. There was a little bit of rally initially on that 8:30 number, which was very interesting, because what is the market thinking? Aha, now we're getting a cut. We'll talk about that a little more in the Fed Watch, because there was huge shift in terms of Fed funds futures this week in terms of getting a cut in September versus not getting a cut in September. So very interesting stuff to talk about there. But the initial reaction was actually a drive higher. Dollar fell down hard on that. Gold rallied, and the futures did have a little bit of pop up, but then they just completely fell apart, because I guess the sugar high of getting a cut in September wasn't enough. So that was the situation there. And that basically caused a very large true gap down lower in the markets. We had some two-sided trade after that, but then came this bomb that was dropped. And this was kind of midday to early afternoon, about, correct me if I'm wrong, 1 p.m.-ish. President Trump says, quote, based on highly provocative statements of the former president of Russia, Dmitry Medvedev, blah, blah, blah. He says, I have ordered 2 nuclear submarines to be positioned in the appropriate regions just in case these foolish and inflammatory statements are more than just that. Words are very important and can often lead to unintended consequences. I hope this will not be one of those instances. And that was one of his posts on Truth Social. So the market did not like that either. We did not end the day as low as we did when the market came off from that. We actually rallied off of those lows. Go figure. But that's basically it. This is basically everything that was behind all of the action that we saw between Thursday and Friday. And as I was saying, I'm kind of thinking about how I can kind of fit this into the program later on, but more on an everyday basis, not just, these that were on Thursday and Friday were very, very specific, and it was definitely causing a lot of the action. I am, of course, a believer, as I've always said, that you should be able to trade in a vacuum without the news. However, this is a very newsy market, and this market has been a very newsy market, I think, since the advent of the tariffs for quite some time now, since they were initially announced. And I just think that in a newsy environment, you kind of have to switch it up a little bit, right? You have to, I'm still 100% strictly technical, always will be. I'll die on that hill no matter what. but it's good to know this news flow and be aware of it and just kind of give some color, if you will, to what was going on technically in the course of the week. So that's that. And now let's get into what's really going on, where we see what's actually really important, how all of this translated into price action on the charts. What's really going on? Of course, where the rubber meets the road, this is the most important section of the program. These are the charts, daily, weekly, sometimes monthly, etc., of S&P and NASDAQ 100, which of course are the two most important benchmarks that I watch all of the time. Today, Friday, August 1st, was somewhat of an important day, technically, I will say, because we lost the 21 EMA, and that's kind of a big deal because the last time the prices were below the 21 EMA was literally in the end of the month of April. We haven't been there in a while. Notice that all the pullbacks here to the 21 since then never closed the daily bar below it, everything that was pulling back to 21 until today. So what are we going to be looking for going forward? You can see that the 8 EMA is starting to roll over. So the question is, do we get a pinch? Remember, a pinch is this, when the faster moving average goes through the slower moving average. That would be, I think, a sign of more selling, a sign that we're actually getting a downtrend. We don't really have a downtrend as of yet, I don't think, in any way, shape, or form. All that's happened is we've just got one day of selling. I mean, even Thursday, which was kind of a pop and flop, we call that, where you gap up and fall, that still closed right at the 8. We still hadn't even violated the 8 EMA here, which is the yellow line. So then we had the gap down on Friday on all of the news that I just talked about, tariffs and employment, etc. And that took the market, that opened us right at the 21, and then we started selling from there. So what is the deal going forward? Very, very important. First of all, let's make this a little bit bigger so we can see this. I find it interesting that the low here on the pullback was 62.01. That's kind of very, very close to the big round number, and today's low was 62.12. This tells me that the figure, as we sometimes call it, of the 6200 is important. I would watch this level very, very closely. This also makes it weak. Remember, we talk about poor lows and weak lows a lot in the market profile. A poor low is something that really is only specific to market profile, but a weak high or weak low can you don't need profile to see a weak high or a weak low, right? A weak high or weak low is simply an area where there is prior reference of a higher low that is being tested, and that multiple test, could it be 2 times, 3 times, 4 times, whatever, that multiple test of that area is simply weakening that reference. So we're calling this 6200 a weak low from here on, because that reference has been weakened because we were here once and now we are here twice. So we're going to see what happens if there is a third time coming down to that 6200. All right, I would keep that very much in mind. Carry forward the gap, if you will, into your narrative. Kind of a market profile term, I get it. Carry forward the gap in your narrative, but even those of you that are just on simple candlestick charts, you can see that. Obviously, we've got a gap there. The way you want to carry this forward in your narrative is very simple. Gaps that remain unfilled are bearish in this case, because in this case, the gap is above us. When the gap is below us, it's bullish. It's a sign of bullishness. It tells you that the market is moving forward to the upside without doing what it was supposed to do, ignoring that poor structure, that structural defect, if you will, behind us. In this case, it's on the upside because we're moving down. So watch this gap. If this gap remains unfilled and the price action is in a way that's just kind of like this, sideways to down, and that eventually may cause the pinch here of the 8 through the 21, then you have a stronger short signal. I was saying today in my weekly options room that when you see the pinch like that, what then happens is that it gives you a lot more carte blanche to start selling calls up here, right? Then with a couple more days of price action that would cause the pinch, it would also give you a downtrend line that you would be able to, let's say it goes like this. I don't know the exact slope of it. I'm just kind of guessing. Maybe it's going to be like that. Maybe it'll be like this, whatever. But regardless, you're going to have a downtrend line. And when you've got an established downtrend line, then it's so much easier to say, okay, I'm short call credit here. I'm short call credit way up here, right? Because it's just that much harder for the market to have to put in the work and clear up over those trend lines to actually change trend. Changing trend in the market, even on a daily chart like this, is not that easy. It really causes a relatively large imbalance of buyers or sellers to cause a trend change. So you want to kind of keep that in mind to see if a downtrend is going to begin in the markets. Let's move over to the NDX. Obviously, very, very similar chart. You've got prior breakout levels here at the 22,251 approximately. Notice that these two references are about the same. I would be watching this area very closely. I think we come in a little bit lower, and that's the area I'd be looking for, basically, is seeing this prior high here to see if it's going to be supportive or a target or whatever. So that's kind of important. And of course, in the NASDAQ 100, you've got the same upside gap that you were seeing in the other one. But again, I think your target area has to be to this prior high breakout point in the NDX, all right? That's it for the technicals on the dailies. Obviously, if we switch this over to the weeklies real quick, just to see how that looks, you can see that because the activity came in on Thursday and Friday together, it all kind of gets melded into this weekly bar. Here's your prior high breakout point down around 6150. I think you see it a little bit clearer on the weekly chart of the S&P. I'd keep that in mind as well, right in this area. Again, knowing that the 6,200 area is weak, that's a key reference, but if we lose that, it's not that much further down to the prior highs, so that's where I'd be looking to see if the market supports what the price action is. And here's the thing, I want to leave you just on this note if I could. And this is where I think being a member of like a trading room like mine, and forgive me in advance, I'm not trying to turn this into a commercial, but it's really where you get a lot of help from somebody like me who's been watching this stuff for literally 25 years every day. I mean, I started trading in the year 2000, literally, because when we talk about supports like this coming down, you have to understand that everything is about tempo and context, which I'm calling out every day live in terms of whether or not you should buy this support, right? How it comes down to this area, if it comes down, is very, very important. And a lot of times seasoned traders will be able to see this difference, whereas less seasoned traders will just look at this as if it was, they will just be very focused on price. And they'll be like, oh my God, we've lost the 6,200. Or, we're moving towards, towards the 6,150 or whatever. But it's really how we get there that tells you everything. And so if you can, join me, but if you can't, watch very, very closely, and you want to really be watching when the 6,200 gets hit, if I should say, but let's just say it does, what was tone, tempo, and market internals as we are coming to it? Did you come down to the 6,200 on all 11 sectors, for instance, dark red, down more than 50 basis from their open? Or was it more of a mixed bag where there was money flow coming out of technology and financials and moving into, you name it, discretionary, energy, industrial, communications, whatever? That makes a huge difference. That's not a market that's probably going to crash through. When a market's going to crash through, or when it's in a very, very bearish situation, remember, everything's getting thrown out. Baby with the bathwater, they call it, right? It's everything. All the sectors are going to be down. The breadth is going to be 6, 7, 8 to 1 negative. You'll have multiple minus 1,000 ticks, right? Kind of banging in the red down there. So this is very important. I can't talk to you about this context in these weekend editions because we're getting together only once a week and only when the market is closed. But if I can leave you with any advice as the market comes into levels, pay attention to context, tone, and tempo. Time now for a little Fed watch. We had a meeting this week, and of course, nothing happened, but it's never about that. It's always about the comments at the press conference, etc. And here's where things kind of went awry a bit. This was a very interesting week in terms of the Fed, and that's why I specifically wanted to do a Fed watch in today's program. Let's just start with the first thing, which was Wednesday. There was no cut. That was what was expected. It was like baked in, or obviously. The Fed is very transparent, and we have these Fed funds futures here that you see on the screen telling us what's up. But Powell's comments were essentially hawkish. Like, he was kind of saying, we may not do anything in September. And the odds of the September cut then, it fell after that. But then we came into Friday morning and everything shifted on that employment data, as I was telling you. The dollar dropped, gold rallied. Employment data came in super weak, telling us that, okay, so the economy is not running as hot as we thought. The economy is actually weaker than we thought, I guess. And look what happened. Huge shift. Now we've got an 83% chance of a cut in September. And you can see how here that target rate, which is currently 4.25 to 450, but this is the one you want to look at right here, is what were the odds of moving down a quarter point? And look here. A month ago, it was 73%. Then it dropped down to 61. A day ago, it was 37.7. So you can see how it just kept falling. And then all of a sudden, out of the blue, today we go to 83. And so you have this huge shift. So it feels like now we might be getting a cut in the month of September. And while we're on this, keep in mind that this, to me at least, is what's causing a lot of back and forth action in the market. This is the push-pull element of weak economy should have markets lower, but we're getting a cut, and that's the sugar rush, and so the market wants to adjust to that. Now, I personally think that the market has already been pricing in, knowing that it was probably getting 1 to 2 cuts towards the end of 2025. So how much is this going to help now? I don't know. This is going to be very, very fascinating to see in September if we actually get the cut. We probably will. If this Fed funds futures percentage stays above 80, I would say the odds are that we get it. But as always, more importantly, how will the market react, right? Will it be enough? Will it be a buy on the rumor, sell on the news, or whatever? But regardless, let's just wait and see. That's going to happen on September 17th. We obviously have a ways to go. We've barely started August, so we've got the full 6 weeks basically before we get the next meeting. But that's the situation. I would continue to monitor this very, very closely, even on a daily basis if you can, and see what those target rate probabilities are going to be for that cut on that September 17th meeting. Let's take a very short trip through the market profile. I only have 3 things I want to talk about vis-a-vis the profile. The first is that we have to carry forward this overnight high, and to a degree this one, because it has now been twice that an auction has ended on an overnight high. And as we know, that generally is not how auctions should end. So I want everybody to carry forward this high, especially as the high of a move. So the way you look at this is very simple. When the high of a move is made in the futures market, but not made in the cash market, that high is generally unsecure, which means that the market very often comes back and retests that area and makes a new high in an RTH session or regular trading hours. And that, if it has excess on top, if it's a true excess high, that is a true end of the move and can really kind of signal that that up auction is officially over. And if you look closely, as far as the RTH session is concerned, which was here, the 731 Thursday high, there is clearly a lack of material excess. So as far as the RTH sessions are concerned, this auction didn't end very well. We do not have excess high on the RTH sessions. And that's important. Again, when the auction doesn't end well, the market should come back and repair that structure. So just something to keep in mind. Now, obviously with the caveat, if we get into a protracted down move here and we're down for the next, say, month or so, this sort of data is going to, at that point, bear less weight. Obviously, the market is eventually going to go back up and eventually going to go higher than 6,500 or whatever. But again, you'd kind of probably take that out of your narrative at that point and only bring that back into your narrative when we start advancing further. So this would more be some information that you would probably be using next week or the week after, if, for instance, that gap that I just showed you in the cash markets, and we'll see it here shortly in the profile, if that gap fills and now it's like, oh, okay, looks like we're starting to go back up again, what are the odds that we're going to make a new high? Okay, I think those odds are pretty strong, actually, that we are going to make a new high in the cash market because we've got that overnight activity kind of sitting out there, okay? So carry that forward. Okay, secondly, I touched upon this a second ago, huge gap, which you want to carry forward in your narrative. But what I really want to talk about, here's your gap, really want to talk about is the fact that the value has shifted in a major way, like E40, major way to the downside, right? Look at this value. And here's value on Thursday. And why is that important? Because it hasn't happened in a while. Look at all the value areas here. Like certainly there are days when the market was down and value was lower, like here and here, but nothing as exaggerated as this, where you've got the value from Thursday here, basically from the 63.71 upwards, and you've got the value here on Friday from 62.81 to 62.55 roughly. So a huge shift in value lower is much, much more important than a shift in price lower. Keep that in mind. That is important. And we did get, I would say, decent POC migration to the downside in terms of being here, right? Developing halfback, which is now the actual halfback, is developing while the day is going on, is here. That's the midpoint of the session. Here's the settlement, but look where the fairest price to do business was. It was all the way down here. That's a little bit more bearish than bullish, basically. You just want to take it like that, right? It would be far less bearish if, for instance, you had this same distribution here, but you had maybe a POC up here, right? That can happen. You could have, I mean, probably if that happened, you'd have a value area expanded out. It's relatively rare to have a POC outside of value, but let's just say, what if it was here? So, just things to carry forward. These nuances, as I've always said, really are twofold in terms of their purpose and usefulness or utility, if you will. It's not just about futures day trading. It's really helpful for futures day trading, but it's also a tool to confirm or deny bias in the market because it gives us so many more signposts than exist in candlestick charts. In candlestick charts, you can really only say, well, if it takes out the high of 3 days ago, then the tone has changed or whatever, or maybe you can draw a trend line or whatever. But in the market profile, you've got single prints, points of control, extremes of value areas. There's just so much here to unpack that's going to give you ideas of like, okay, well, if this happens, then the tone changes or right here. And you're going to be able to see those tone shifts a lot faster than a person who is just relying on candlestick charts because they're simply not going to see this information. It's just not there in a more two-dimensional view of the market. All right, as I was saying, I have 3 things. The third thing is just really quick reminder of my market profile course, which I am diligently working on. I know it's been taking much, much more time than I thought, but it is super comprehensive and very long. And I'm looking at like multiple hours worth of footage now, putting together in a very comprehensive soup to nuts, starting with a TPO, the one little letter where it all begins, going all the way out to the most advanced market profile theory, and most importantly, with an entire section of real life examples showing you how this stuff works when it is applied to live markets. So that's really, really the most important part. It's going to be basics, theory, and application. I'm very, very excited about that. And fingers crossed, I'm hoping at some point during the month of September, probably, this will be launched. You will receive an email and it'll be all over our site, and I'll be talking it up on socials as well. So get ready for that. That is the market profile course. Time for a few trade ideas here. Caveat, I don't know what the market's going to do. Obviously, everything kind of follows the market, but I like to look at relative strength, which is most important. And 2 of the 3 names we're going to talk about today are in the Fangman plus T group. And when I show you these, I'm also going to show you some of the other names in the group that are not as strong. So I think it'll kind of juxtaposition well, so you get an idea of why I like these better than the others. So Meta reported recently, and notice that there's been this gap higher, but the trend is still clearly intact here. And the trend line is not going to come in till about here. I think this 700 area is pretty safe. And this is an area that I would be looking to sell some puts below the 700, especially as prices come down and kind of pump up the volume a little bit in those 700 puts. I'd be looking at that as a trade. So that's Meta. Next one is Netflix. So I want you to think about what this chart looks like. I've showed you this chart before with these things drawn on, with the 15%, 20%, and 25% decline marked off as areas where longer term investors may want to pick up some shares. What I want to point you to today, and if I could just make it bigger a little bit here, let me see if I can clear this off and then make this bigger. And just kind of look at what does the candle today look like in relation to the market, right? Like what does the QQQ candle look like today? And what does Netflix look like? To me, this looks like this is just going down very begrudgingly. All of this is just no major like expansion of the range to the downside that actually follows through. Like, don't get me wrong, there's some expansion of range here, But where's the follow through? Like, this is an expansion of range to the downside, and the next day takes back like 75% of the day. And this is an expansion of range to the downside, but it doesn't really go anywhere because 4 days later, you're back up here inside of range, right? Like a clean downward move looks like this, right? Candle, 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 right? Big expansions of range that just keep going in one direction. I'm not seeing it really. So this could be a buy on a pullback. The 15% decline level is here at about 1140, give or take a couple bucks right there. So that's something you may want to think about. I've been saying for a while that this 1060 area breakout level, see how this high here is 1064.50? And I've been saying for a while that in my room that the 1060 puts are a good place to start. Is just to be selling the 1060 puts and looking for to get filled there, or basically get, even if those get exercised against you, meaning put on size where you're comfortable owning the stock at 1060, because I think that prior breakout point could be it. Basically I should say my main takeaway here is very similar to what I was saying earlier in the program, where I was touching upon, as things come down, you want to pay very, very close attention to tone and tempo and market internals. Now, in this case, market internals don't really come into play because we're talking about an individual stock and not of the broad market. But the tone and the tempo of this decline is very, very important, and that should give you the confidence to buy the stock on a pullback. If the tone and tempo and tenor, if you will, of this decline stays the way it is, I would be a buyer of Netflix at some of these levels. And then also when you break trend, which hasn't happened yet, but that's the easiest way, right? Is just to put your trend line here, and then when you see the break in trend, which would be right here, wherever that is, be it here or happens down here, boom, that's your buy point basically once you break that downtrend line, okay? So keep that in mind. All right, that's Netflix. Last one is a little bit riskier, I would say, and it's Coinbase. I like this because they reported, and the stock, I should say, kind of a disappointing quarter. Market didn't like it, but I just mentioned it because it's a high flyer. It's got propensity to really move, and we're coming into a trend line. So you've got some key technical action that you need to be paying attention to next week and see if traders buy this up. You can certainly have some limit orders right on it. That's how I like to do it. I like to have limit orders kind of right on these levels. And do it. Probably not overnight, I will say that, meaning I would let the stock open on Monday or whatever. Here, if it opens below, then forget it, it's no trade. But if it opens above and I haven't come to the trend line yet, I would put the limit order right here and kind of let it get filled. I like to put just like 100 shares just to kind of wake me up and tell me, hey, you're on the dance floor, this is happening. And then I can switch down to a 1 minute chart and see how the price action is going, and then put on the full position once I see that it's okay. If it hits the limit order and keeps tanking lower, well then you know that it's probably not going to be a trade if you lose the trend line and you lose a few $100s and you move on from there. So I think Coinbase is going to be one to watch as well in the near future. Bitcoin obviously had the large pullback this week, as I was saying. I touched upon this earlier in the program. I was saying that the prior high breakout point here in the continuous contract has not yet been tested, but if you look at the current contract, it actually went below this level. And so for me, I have no position right now. I am flat Bitcoin futures. For now, I don't want to be part of it. I'm just kind of watching closely, see how that happens. I mention this only because I think it does have some effect on Coinbase. It's not as specific of like a one-to-one, like a strategy, MSTR, but certainly a bullish Bitcoin definitely helps Coinbase a lot, and a bearish Bitcoin does not as much. So this is also something you want to be watching for. If you're going to be buying that trend line, you probably want to see that at that time, Bitcoin is holding these prior highs here on the continuous contract and is not breaking through these circled areas, and I think that would help Coinbase to have a little bit of a reaction at that trend line. Okay, let's see what's popping on the economic and earnings front for next week. Looking ahead, August 4th to August 8th, we're still hot and heavy with the earnings. Even though Fangman plus T is over, those are the ones I care most about, except for NVIDIA. NVIDIA, of course, always is a little bit later. They're on their own thing. But a lot of big names still to be reporting. As always, reminder, I only post the stuff I care about, stuff that could be moving, stuff that I may want to trade. I'm not giving you a comprehensive laundry list of every single earnings announcement, so I'm just showing you the ones, again, that I care about. But in that vein, we've got Monday, Transocean and Williams are going to kick off the week with two names in the energy space, one in oil and one in natural gas. Interestingly enough, Tuesday is going to be an ISM services number. That could be a market mover. Also, same thing on the economic front. I only talk about the high impact releases. I'm not going to get into any minutia of all the small economic data that really doesn't mean anything. There's tons more economic data every single week than what I mentioned, but I only talk about the big ones that matter. Also on that Tuesday, we are going to get Caterpillar, Yum Brands, Rivian, which could be interesting, and Toast. So you got the restaurant space, you got the car space, and you've got Caterpillar, heavy equipment, etc. So two in the restaurant space, car space, and Caterpillar. Monday, McDonald's, could be interesting. Shopify, big stock, big price, big moves. We'll see what happens. Disney, Baba, DoorDash, and then DraftKings and Duolingo as well. Duolingo was a market darling, kind of fallen out of favor a little bit since then. We'll see what they have to bring us. Thursday is always the same. It's always initial claims and continuing claims. There's always employment data, always on a Thursday. And Friday is going to have Papa John's, ticker PZZA, which is appropriate, I guess. And also Atlassian, which has ticker TEAM, which is also kind of appropriate, I guess. All right, so that is our looking ahead for the week of August 4th to August 8th as far as economic data and earnings releases are concerned. And that's the show for today. Thank you so much for spending a little bit of your weekend with me. Big announcement, I am taking a little bit of much needed time off. So you will not see Weekend Edition next weekend or the weekend after. I will be back on August 22nd. I had to check my calendar for that. So August 22nd will be the next Weekend Edition as I go a little bit on hiatus. Let's recap a little bit of what we were discussing in today's program. I think that this is going to be a little bit of push-pull going forward between economic data, tariffs, and the fact that now we are pricing in a cut in September, which the market likes. So kind of keep that in mind. Also just keep in mind that this is probably one of the most newsy and sensitive environments that we've been in a while. So if you want to take your size down a few notches, it's also summertime. Overall volumes may be lower, which could be contributing to a little bit of the sort of herky-jerky volatility. Just keep all of that in mind as you navigate over the next few weeks. Remember that the best time to trade in the markets is usually the fall-winter period. Markets tend to be bullish, and they just tend to trend much better with stronger volumes. So that's going to be interesting. All right, so remember, like and subscribe. Super duper important. That always helps the channel. We crossed that 100,000 milestone recently, and we got our silver award from YouTube, which I'm very proud of. And hopefully let's push this channel up to the next paver, which is going to be I guess 200,000 subscribers or 500,000 subscribers or whatever. We'll see how that goes, especially when we get into the new studio. It should be very, very exciting. All right, again, I will be off for the next couple of weeks. I'll see you on August 22nd. Until then, I wish you good trading and good night.